Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for June 21st of 2026. Well, we're coming off an off week. Didn't have a charts last week, so we've got a lot of data to kind of catch up on. We're going to flip the script a little bit. We'll end the broadcast today with the economic data, but we'll start off with the markets here. So we've seen a consistent rise in earnings per share, especially if you look at next 12 months. You can see that, like, basically starting last year, we've seen a tremendous increase in the estimates. We've been monitoring this for some time. When we looked at both 2026, those numbers came up. 2025 was rather muted, and then already here for 2027, the estimates looking out on the horizon, and obviously this would have been looking out into 2027 in January of 2025. And so if you follow along how this is, just say, like, look at the beginning of the year. Even from the beginning of the year, estimates for not only the next 12 months have gone up, the estimates for 2026 have gone up, as well as for 2027. So a lot of optimism being built into earnings at this point, looking into the last half of the year, despite some of these other headwinds like sticky inflation and trade imbalances and things like that. Now we'll look at valuations in the market. This is a PE ratio looking at various slices of the market. We've got the S&P 500 large cap forward PE, price to earnings ratio, in the red number here. You can see that has trended very high, and if you go back to before the global financial crisis, you can see once again that these are levels that are very, very high relative to historical trends. And the blue line represents the mid caps, the S&P 400, and then green line represents small cap S&P 600. And those have been in really lockstep for a very long time. And again, there is some, kind of like overlap in terms of, because it is a moving target with these index constituents, and some are growing, some are not, so on and so forth. And so there tends to be a lot more correlation between mid cap and small cap than there is between those two and large cap. But having said that, we have had some moderation of valuation relative to its peak, but as we'll see, the market is still very concentrated in technology, although there are some ironies within that, and we'll touch on that very briefly. But long story short here is that when you think about everything but large cap, those stocks that are not large cap have a relative valuation that's actually not out of line versus historical standards. And you could argue, looking into this decade that followed the global financial crisis, that these stocks are cheap relative to that, but certainly not the large caps. So we have tighter conditions that are kind of setting the stage here. And so this is just excess liquidity in the market. And so, how we will define this is real money growth relative to overall economic growth. And you can see here that this would be the excess liquidity leading indicator. So this is kind of showing, like, how much juice is there available to continue this particular rise in multiples and this kind of melt up that we've seen. And you can see this indicator seems to suggest that at some point we're going to have a kind of a stall, if you will. Now we'll look at U.S. common stocks that are up more than 100% in a quarter. You can see that we've had, again, this concentration of market wealth within a lot of the very large names that have gone up quite a bit, and certainly semiconductor names since the beginning of the year certainly fit that pattern. We've had a lot of semiconductor stocks that have gone up a tremendous amount, even more than 100%. And you can see that going back to 1996, that you have these little bouts of speculation, notwithstanding dot-coms and meme stocks, if you will. But you can see that generally these episodes don't last too long, but we have seen this kind of like uptrend, if you will, in various stocks over the last 2 to 3 years. So here's a chart that I think tells a lot of this story. So this is change in market cap since the beginning of the year. If you look at energy and the AI related stocks, look at the green here. This is energy. Obviously, we know what's going on with energy prices and commodity prices there. This is AI. We know exactly what's going on there. And how they have influenced the overall S&P 500. But if you back out those two areas of the market and you go back to almost the beginning of the year, call it February, the rest of the market has actually been down. And so this highlights, I think, one of the risk factors of the market, that we have a concentration of outperformance within a relatively narrow subsector of the market. This is great research by Apollo, and I think this highlights here in these blue stocks. This would be X energy and AI, essentially the rest of the S&P 500 that's not these two, and you can see how that creates some risk if the engine that's embedded in these two areas stalls at some point. This is the irony that I mentioned before. Actually, when you look at, looking at total return for 2026, the Mag 7 is actually down slightly. So this is not a Magnificent 7 story in 2026. It is actually energy and, as we'll maybe see here in a second, semiconductors. So we've had a lot of money flows into tech stocks and to tech funds in particular. This is a Bank of America global research piece. You can see we've had really record inflows into these things, and it's created a lot of speculation, which has caused prices to go up and obviously creates more of these headwinds from the chart that we just saw because of that concentration relative to the broader market, which has not performed nearly as well. Here we have retail cash. This is also very important. So we have a ton of trading coming out of the retail sector. And this, when I say retail, these are not hedge funds. This is not, institutional investors. This is you and I throwing money into the market. And so I think some of this is kind of like fueled by some of the IPO fever. We've got SpaceX and the build up to that. We've got the tech stocks, which are really kind of catching a lot of the headlines and drawing a lot of interest from the investing public. Over here, we've got household cash as a percent of total financial assets, and this is something else that I think is particularly telling. We have a ton of retail cash that actually is sitting on the sidelines. So not only have we had a tremendous surge in retail investment, but we still have a lot of liquidity on the sidelines. And so I've talked to you at various points in time about, the ability to melt up is a byproduct of several things. And obviously, we've just talked about valuations being relatively high, and we've also talked about foreign direct investment, with foreign investment dollars coming in because of changes in the US dollar. That's certainly been an impact, but this is another piece of the puzzle right here, another reason why the market is melting up. Average market cap, this is the top 20 and the MSCI All Country World Index. It's 60 times higher than the average stock of the remaining index, which can essentially consists of 2,500 stocks. So, and you can see, again, a multi-year phenomenon here, but starting about 2017. You began to witness this upward trajectory here of increased concentration within the MSCI. And this is another, basically another chart looking more globally at what's going on here in the US. That chart that I showed you, that the stocks that are performing well are very concentrated, and the rest of the index is actually not outperforming at all. And so again, not only is it happening in the US, but it's also happening across the world indices as well. Semiconductors. This is the story of the day here. almost 19% of the S&P 500 weight. We already know that the concentration of AI and the Mag 7, you add it all up and you throw semiconductor in, we're really talking about like 50% or half of the S&P 500 is driven by AI, semiconductors, and the large, ultra large mega cap, the hyperscalers, et cetera. And you can see that this is a very much an anomaly, that the line of best fit here is probably somewhere around here, like maybe 5% if you're generous. That's about 19%, and it happened in a very short period of time. Momentum stocks, as we know, are on the go, and a lot of these are semiconductor stocks. And again, Alpine Macro does a good job here. Here's your line of best fit, and here is the massive overshoot. And it's not uncommon to have these overshoots periodically, but the magnitude that we've seen here, and again, I'm not going to get into the math of all this, but let's just say that 5 standard deviations is literally a once in 1,000 occurrence, and that's where we are now. And what is this chart? And so it's showing you momentum versus the minimum volatility, stock allocations. And so you think about, to simplify this, you've got your momentum funds and you have your stable or minimum volatility funds. And let's just say that in this case, momentum is incredibly outperforming the minimum volatility stocks and those funds. Here's another chart that I think paints the risk picture that I've been kind of outlining in some of these other charts so far, is that you have the NASDAQ 100, and this is looking at the implied volatility of this index relative to the S&P 500. Again, great work by Apollo here to kind of show you that the volatility within technology, even though we've had this dramatic increase in the concentration of tech within the S&P 500, that the volatility within that is picking up. And so the implied volatility of technology at a time where tech is really taking the reins in the market, it sets the stage for increased overall market volatility. So another chart that talks about the volatility, like the internal volatility within the market. So this is the single stock implied volatility premium. Again, there's a lot of math to this, but suffice it to say that while this is trending up, it's recently accelerated. And so this is, again, this lays the stage for the potential for increased volatility coming up in the months ahead, just because you've got individual stock volatility that's really picked up. And frankly, I don't have a chart this time, but when you look at the average stock drawdown chart, and Schwab does a really good job of this, the average stock has had 10, 20, 30% drawdowns within this year. Obviously, the index hasn't, but individually, a lot of stocks have, and that's kind of reflected in this volatility figure here. Another phenomenon in the market is that we've seen corporate buybacks really drop here as of late. And again, when you think about the index as being maybe a little tech-heavy, tech-centric now, and you think about what's going on in the technology sector, there's a lot of capital spending that's going on. And so as a result of that, they're not buying back nearly as much stock. And in fact, in some areas of the market, that has really dried up to barely a trickle. And what this implies is you're not getting as much shareholder return by virtue of these buybacks, and reducing your stock float of individual stocks, that it's being redirected to capital spending, which could be good if it's generating strong returns, for the average shareholder. But again, a dynamic that, even though this is proven to be somewhat volatile over time, just to highlight the fact that that is definitely in place right now, where buybacks are not in vogue. Negative earnings companies are catching a bid. So this is a pure sign of speculation right here. So here we get in the green line, we've got Russell 2000, again, small caps, small companies, and we actually know that there's probably 40% of the Russell 2000 that actually does have negative earnings. But guess what? They have outperformed companies with positive earnings per share, and that's really telling. So that's a sign of speculation. Again, you could see these things kind of trading in lockstep, although going back to April of 25 is not a large historical backdrop, but at least for this period of time it was. And then you could see the deviation here, and the deviation, frankly, has just continued to grow. So, companies without earnings catching a bid versus the ones that are generating earnings is, I would say, unusual at best. It's fundamentally, unstable. It creates these instabilities in the market, but it's just a sign that you've got a lot of liquidity chasing a lot of companies. Total returns. I go back here because we have if you look back at the pandemic, and there's a lot of data that we look at where I'm highlighting, well, here since the pandemic or after the pandemic, and when we talk about that in economic terms, but here in the market terms. So if we go back to the market shutdown, and this is a point where it happened very quickly, and the market dipped and then went back up. If you stayed invested, within a few months, you'd kind of forgotten that the market even went down, or you probably would have, or should have. And but the emotions of the day, it's really important. The steadfast investing piece of this is resisting the behavioral impulses to want to sell when things are bad are really powerful. Well, guess what? If you had sold and you were panicked and you got out of the market and said, all right, this is too much for me, boom, you would have had 1.5% annualized return from that point. Again, if you had you've forgotten to open turn on your cell phone or watch TV, just you were blissfully ignorant to anything that might have gone on for that short period of time, you would have seen a 15-16% annualized growth rate, not without a little bit of pain points along the way, but that's the price that you pay for outperformance. You accept a little bit of volatility in the near term to achieve longer term results. And frankly, if you go back to May of 2016 and you look at this line of best fit, it looks remarkably straight, point to point, and you've just oscillated at various points along the way. So yet another powerful slide that shows you that staying in the market, not reacting to behavioral impulses, is super important. Here we have market is really doing the Fed's job in some respects for it, because it is kind of tightening things down, it's tightening conditions on its own, because you've got basically real yields that continue to move higher because of this inflation. Again, it just we've seen periods of this before when real yields are moving higher, and I think if you're looking at what the Fed's job is, there's oftentimes market forces that are doing the work that policymakers would otherwise have to, and we're at that point right now. Another thing we watch is credit, and we've got the spread. We've got junk spreads essentially. This is a triple C rated bond, so these are bonds that have a much higher risk of default, and this is triple C bonds over higher junk debt even. So this is like looking internally within that whole high yield space, and you've got those more risky bonds where we've seen this explosion in credit spreads. Now we're going to pivot a little bit, talk about energy commodity markets here a little bit. Obviously, as I'm sitting here recording this on Sunday, Sunday the 21st, we've actually seen some more news yesterday that Iran is now firing. They claim that the ceasefire has been violated, and all of this work and groundwork that seems to have been laid last week with regard to the truce and maybe this memorandum of understanding, is maybe unwound. But again, this could change by the day, and this has changed by the day. But as we sit here today, Crude prices have come down on the speculation of a broader framework of an agreement to stop the hostilities in Iran and open the Strait of Hormuz. But again, commodity prices can be volatile. Crude oil stocks. This is the real thing that I want to drill down on with regard to oil. And obviously, the strait has been closed effectively for a while. And I think this is something that the world has realized that Iran does have more leverage over that than maybe people thought they did. Well, guess what? Crude oil stocks are down. And this is the shaded area represents the 5-year average or the 5-year range rather. And gasoline stocks below that range, distillate stocks below that range. And obviously, if you have crude that gets cracked into these things, if those stocks are low, then obviously these are going to follow at some point. But here's the other thing. So this represents a point where the Strategic Petroleum Reserve is full. This is as of June 15th. Technically, it would be full if it had 714 million barrels. Right now, we are very, very low. In fact, to levels that we haven't seen since the early 80s, in fact. And so, again, the thought is if we have more hostilities, if the strait remains closed for perhaps another 2 months, we run the risk of heading into September and the early fall months of having an energy price shock because these stocks are so low. And there are, at that point, there's really no levers to stop prices from moving up in energy, and that would cause some other problems certainly. Oil inventories, looking at it a little bit differently. So last slide, we have the Strategic Petroleum Reserve of the U.S. This is something that I kind of showed you probably a few weeks ago. These are world stocks, and where they are now is basically operational stress levels. So obviously they've come down. We know that, U.S. as well as the world. But here's what I'm talking about. If you get to September and we don't have more shipments of crude, and we're kind of in this stuck in the status quo, we're going to be at a level where you're going to be struggling to keep pipelines functioning, refineries operating at high utilization rates, which is really important for those refineries. And that could lead to some very unwanted kind of inflation born out of the energy sector. Interesting, a little piece of data here that coal that used to fuel and power America is being slowly replaced. Now we do know that environmentally speaking, coal is even a lignite, a clean coal, so to speak, is dirty and not good for our environment. So you can see that the production of and the use of coal for power generation has come down. At the same time, we've seen these kind of like seasonal intonations of solar that have increased. And we have seen for now the first time that solar is a larger contributor to the power grid than coal. Copper prices, we know that you think about data center and to a lesser extent some measures of constructions. Obviously, it's an industrial metal, and when you have build out increases, and you're going to have commodity price increases. So data center demand, obviously you're building more data centers, that entails a lot more wiring, which entails a lot more copper. Now we kind of slide over and look at gold, which has been kind of kind of the darling child, if you will, at a time where equities, showed some bouts of volatility. Well, gold has come off its peak price, as has silver. And I would submit that both of these got overbought. But the interesting thing about gold is it is becoming a very strong alternative to U.S. Treasuries on the part of foreign central banks to maintain their reserves. And I'd say that gold, some of this price rise is driven by that, some of it pure speculation. But the fact that silver has also participated in that speculative bubble, so to speak, tells me that this has more to do with speculation, looking for kind of a defensive asset at a period of increased valuations, but also kind of a byproduct of increased liquidity, wanting to find a home in the market versus necessarily just that central bank gold purchasing phenomenon. Here we have cattle futures, no surprise there. They continue to move higher. We're at all-time highs. Beef prices, as you know, are very high at the supermarket. So again, I don't see that changing really much of any time soon, unless we get a little bit of help with El Nino, with increased precipitation, which obviously helps to, if you're raising animals and you have a drought, there's no hay to feed the animals, but if you have more precipitation, then you get a little bit of the opposite. So hopefully that will help the thinning herd issue that we've had to deal with for many, many years now. Couple of slides here on the private markets and deal flows, and obviously we've seen a lot of stress in private credit, a lot of redemption requests, and I think honestly it's kind of overblown, but they are still continuing. But as a result of AI and the feeling that artificial intelligence is going to displace a lot of software technology that exists today, you see buyout deals are going down. And relative to the rest of all deals, we do know that here's another chart that kind of represents that. This is a software buyout activity for the first 5 months of the year, as continuing to move lower and probably will maintain consistent levels to 23 to 25 perhaps by the end of the year, but just know that software deals are becoming less in vogue. Here we have mergers and acquisitions activity. So outside of the software sector, deal flow is very, very strong, very encouraging. In fact, so we've seen a lot of VC-backed companies. We've seen acquisitions of VC-backed companies, and this is a very healthy sign for the private markets, particularly private equity, and the mobility. And the multiplier effect of those buyouts is tremendous, because you build a company for call it 100 million, you sell it for 300 million. Obviously, that's 200 million of new capital that goes into new companies, new investments, and so there is a multiplier effect. And it's good to see the increases in liquidity in that space, because that's a very important part of the business growth in this country. And let's slide over here and look at private infrastructure and real estate funds. They've got a tremendous level of assets here. A lot of investments in infrastructure. And this is a theme that we started talking about really about 2 years ago, and it picked up a lot of steam last year. This is going to be a theme that we're going to be talking about for a while, because there really is, honest to God, opportunity in the infrastructure side, not only on new build, but also retrofit and rebuild. And again, this is very wide enough you could drive a truck through it. I mean, it could be data centers, but it could also be roads, bridges. It could be utility plants. It could be power generation. It could be a lot of things that in some cases have very strong codependencies like power generation and data centers. So policy rate. So we had Kevin Warsh's first Fed meeting here this past week, and it was unremarkable in the sense that there was not a policy rate change. So we're still, kind of holding steady, but a couple very important takeaways. So the statement that the Federal Open Market Committee made was pared down greatly. So this is one of the things that Kevin Warsh wants to do. Several things he wants to do. One is kind of reduce the verbiage, make the message very clear and simple. He also wants to reduce the outlooks out there, and he himself actually did not produce an input into the dot plot estimates. He wants to reform it in a lot of other ways, like looking at the data points that the Fed looks at and says, are they still viable? Are we getting enough responses to where it's statistically significant in helping to inform them on policy change potential? There's a lot of things he wants to do, and I think in many respects it's very productive. But stepping out of this meeting, the inflation estimate, at least near term, was increased, and both at the personal consumption expenditures and the core PCE level. So inflation is expected to be higher, which is now setting the stage for an increased probability of rate hikes versus the 2 rate cuts that we were expecting from these dot plots earlier this year. So here's the issue with the Fed and where rate and rate policy and more generally monetary policy is kind of stuck right now. And so we know that we've got payrolls that we're in kind of a no fire, no hire level, and you can see that some of these more benign data points and maybe a little bit stronger perhaps lately. So things are not necessarily bad in labor. You might argue that we're probably functionally closer to stability within the labor markets right now based on current economic activity. However, you've got a surge in inflation and in a lot of areas, and you've got GDP that is actually this is a first quarter 1.6. This is basically that most recent reading that we got, the revisions, and we'll take a quick look at the estimates for the second quarter here in a second from the Atlanta Fed, and looking a little bit bolder than that. But the bottom line is you've got prices that are higher, you've got labor that is kind of stable, and you're certainly not going to reduce. You obviously don't want to, ease credit and have inflation go higher, but you certainly don't need to do a lot to manage the labor market necessarily. So they're really in a position of waiting and seeing and looking at the data over the next several months. So a quick comment on deficits and deficit funding and where that's coming from and what are the implications. We have this slide from Apollo. Again, we know that we've got these ongoing fiscal deficits with really no end in sight. There really seems to be no political impetus on either side of the aisle to address these deficits. And so you've got to fund these deficits somehow. And, you do that at the federal level by issuing more debt and issuing more T-bills, T-bonds, et cetera. And you can see Treasury bills as a percent of all Treasury issuance is like 85%. So, basically over the last several years, as we've been funding these deficits, the overwhelming majority of these are essentially short-term instruments that create a lot of interest rate exposure. And we already know that the interest on the federal debt is now over $1 trillion, and it's creating more crowding out issues with other government spending. And I think that this is the issue that we're going to face. And there are other implications of this too. Well, we already know that foreign central banks own less treasuries, and they've been divesting treasuries, or they've not been replacing maturities. So foreign demand has gone down. Well, you have to have a natural buyer of these treasuries, and foreign central banks have often been that, but they tend to like longer dated, longer term bonds. But if we're issuing about 85% of all new issuance is coming in the form of basically T-bills, which have maturities of less than a year, you're gonna have to find a buyer for that. And I think in the absence of foreign central bank demand, then I think prices are going to be lower, yields are going to be higher. You've got to have higher yields to attract people to want to invest their dollars in these, and I think that creates a situation where this will help to sustain higher interest rates for longer. Quick look at retail sales that were by and large all better than expected, whether you look at the overall number, which was up about 0.4% higher than the estimate. And then if you back out autos or just look at that very tight control group, they were all better than expected. On this side, you can see the primary contributors, not too surprising, gasoline stations with the increased prices for fuel. That's not a surprise, but we also had some benefit from some of these other retailers, non-store, and motor vehicles as well. While we're on the subject of retail sales, I actually thought this chart was pretty interesting. We talk every once in a while about China and what's going on in China, but right now we have an interesting situation in their economy. Retail sales are actually negative, and that's the first time since the end of COVID for China. And again, some of this stuff doesn't get a lot of press, but obviously when China slows down, it becomes almost like a geopolitical type thing in the sense of China's having to maintain more focus internally on its economy and getting the state involved in that, and it distracts them from foreign geopolitics a little bit. Now we'll switch back to the U.S. here. Pending home sales, actually better than expected, and honestly, this is a surprise. Good to see. It's kind of healthy. So the buying intentions seem to be plowing right through mortgage rates, which have gone up a little bit. However, on the builder side, you've got sentiment that's still kind of stuck, and actual units that have been started continue to fall. Growth rate you can see here. So perhaps pending home sales moving higher, but starts are going lower. Building permits continue in this channel. So from a builder's standpoint, you've got really not very much optimism. And if you break it down into single versus multifamily, you can see multifamily probably, if you look over particularly the last year, but maybe the last 6 months, have probably shown more of a decline necessarily than single family. But you can see that the enthusiasm here continues to drop in residential construction and on both the multi and the single family side. Got some data last week from the New York Fed. This is their services activity index, so you can still see that that's negative. It's been holding in there at a negative level for a while, but kind of looking at it through a different lens, we've got a couple of employment data points here, which are actually positive. You think about what's going on in the labor market, kind of no hire, no fire, but in the New York Fed area, you've got current and future responses on current and future conditions positive with regard to number of employees and with regard to wages. So trade is certainly an issue. We can see that being kind of an overall net drag as we look into the next year or so. We've got higher prices both on the import side as well as the export side. You can see import prices of technology components has really moved higher. So you think about memory chips, you think about electrical equipment, and obviously semiconductor components to the extent that they're not manufactured or fabbed here in the U.S. Now, both of these were higher than expected, and you can see the really kind of what I feel is kind of the sustainability element here versus kind of the noisy data that we've seen in the past. But we have basically retraced a lot of what we gave up back in 22, 23, and in a fairly short period of time. We have the consumer price index, which again, we know is moving a little bit higher. This is something that we're going to have to account for when we talk about Fed policy. And so, again, just highlighting that for you here. So technology is usually deflationary, but recently it has not been. I think that's very interesting. When you look at computer software and accessories, or you look at electronic components, they're both moving higher and you look over a longer period of time, going back to the year 2000, and they are more deflationary. You think about your own personal computer. You certainly don't think about iPhones, because I think iPhone prices are moving higher because of these component prices. But over time, you have looked at a lot of different technology in our lives, and you could see how these prices have come down considerably. Looking back at the beginning of this century here to where we are now, but that's obviously not the case at the moment. With all that being said, let's take a look at the Atlanta Fed GDP Now economic growth tracker. Won't spend really any time on the historical data, but rather just on the upcoming initial estimate of second quarter economic growth, which we'll get the third week of next month, that month being July. And right now, looking at 3%, that has been a little bit more optimistic several months ago, but with the increase in inflation, et cetera, the data is pulling us down to around the 3% level, which honestly wouldn't be that bad, but that compares against 1.6% for the first quarter as the reading that we now have. And as you can see, really over time where we are at that 3-point level, what are the contributors? What are the things that are detracting from that number? And obviously net trade, we've got exports here, offset by greater imports, so net drag there, but then positive imports or positive impacts from consumption, as well as business fixed investment, a little bit of inventory build as well. This slide depicts the Business Roundtable CEO survey, and as you can see here, CEOs are pretty optimistic when it comes to sales, capital spending, which certainly is intuitive at this point because we've seen a lot of CapEx, and also the overall outlook remains positive, where we still see some sluggish signs coming out of the CEO ranks is in employment, which is not a surprise either. And we've talked a little bit about labor. This is some data coming out of the National Federation of Independent Businesses. Their hiring intentions, as you can see here, very, very low. So while businesses aren't necessarily firing a lot of people, they're just not intending to hire them either. And so that's created this little point of stasis that we're now at in the labor market. And here's private payrolls, looking kind of like steadying themselves out, and this is kind of a bit of noise here, but you can see that we're kind of in this channel right now, but future intentions currently suppressed. Now we look at household net wealth, and a few cross currents here. One, we'll look at the K-shaped economy. So here's your bottom 50% of the income cohort. They really haven't seen that much of a change in net wealth over a period of time on a real basis. Now you get the middle income cohorts. They have seen a fairly meaningful increase in their net wealth, and then obviously the top 10 has seen a tremendous amount of net wealth. These are generally the people that you find more active in the stock markets. They have a diversified asset portfolio, more real estate, more alternatives, so on and so forth. you've got a lot of stock and 401ks and things like that here. And as we just saw earlier in the slide deck, you've got a lot more retail investing here. And so as the markets are compounding and going up and people are adding more money to their portfolios, et cetera, you're seeing this deviation relative to the bottom 50, where a lot of these people are much more impacted by the cost of gasoline, the cost of groceries at the supermarket, et cetera. Discretionary spending, we talked about retail sales, but been actually very strong lately. So we know credit card balances are moving up, so people are finding ways to spend money. That's not necessarily sustainable, but it is going on right now. So you look at not only travel and leisure and restaurant spending, it's all been relatively strong. The irony is, and we were sitting in 2025, I never would have suspected we'd see numbers that were this strong, but just caveat that some of it is driven by income, but some of it is also driven by increases in credit. Consumer spending holding up pretty well despite energy. And again, we've talked about the different impacts on income cohorts. So the red is in the euro area, the blue is the U.S. area for both these categories. Here's real monthly goods spending right here, and here's energy prices, which have gone up greater in the U.S. Than in the euro area. But again, not impacting overall spending. It's just hitting the lower income cohorts a lot more. We've also had, by virtue of the OBBBA, the One Big Beautiful Bill Act, some increase in cash flow to households from tax law changes. And you can see here that real disposable personal cash flow, created a little bit of an additional surplus of dry powder versus what it would have been. And you can see that there was during filing season, there was a surge in this extra personal cash flow. But I would say that is going to be a short-lived phenomenon. And actually that type of a benefit will completely go away, I believe, by the end of the next month. Producer prices, something we had a little bit earlier. If I'd done a chart pack last week, this would have been in that. But again, we saw a surge in producer prices. These were a little bit, the headline was ahead of expectation. The core PPI was a little bit lower than expectation. But the takeaway here is they're both moving higher. And here's PPI less food, energy, and trade services. There's your number there. And then energy, as we know, is a prime contributor to the inflation that we're seeing in producer prices. But this is eventually the type of thing that gets passed through to retail investors from those producers. This is interesting to me because this shows kind of a change in sentiment with regard to gold reserves. In fact, I should have side saddled this chart with gold prices when we were talking about commodities. But you can see here, 2026, almost 90% expect global central bank gold reserves to increase. You can see in prior years that was not nearly as much, and so it just highlights the kind of the continued underpinnings to gold prices, even though they have kind of course corrected here over the last couple of months. Social Security, something else that's very near and dear to our hearts as financial planners, is doing the strategy work around that. But just like we've talked about in the past, there's been several times in my lifetime where we've had predictions that the Social Security Trust Fund would run out because we don't have enough workers to help support the number of retirees. We're not replacing those workers as well as we had, and so this is showing that basically sometime in the 2030s that we're going to have some type of an institutional change to Social Security, like the recipient age might get moved up from 67 as a retirement age to 70, but then you could also see a potential for cuts in benefits and maybe even some means testing for people that if they've got alternative sources of income, maybe they're not eligible to receive as much. There are lots of levers that can be pulled, but just to say that the mid 2030s is when, or starting from like 2032 is when policymakers, at least right now, are figuring that something will have to be done to address Social Security and the trust fund running thin. That's all we have for the chart pack this week. Hope you've had a great week, and we'll talk to you again soon.